This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on, Kimberly Flynn with XA Investments. And as the name of the podcast goes, alternative investments being a topic of conversation here, that's exactly what we're going to be talking about today. There's a few different things that are currently happening in the marketplace with regard to exposure for 401ks and retirement plans that are going to be potentially be allowed to invest more in the alternative asset space, also kind of the general marketplace and how people like Kimberly are trying to bring about the democratization of alternative assets to people because for many years, and especially leading up to 2013 with the passing of the Jobs Act, it was a very walled garden, right? You had to know someone who had to know someone to kind of let you in, give you the keys to the kingdom, and then you could run around and play with all these otherwise unavailable assets. And through the past 12 years or so, we've definitely seen a big growth in that market sector, but there's still work to be done, especially what we do here at Advanta with trying to educate people on the ability to do these things, especially within tax shelters such as IRAs and 401ks. It's great to have guests on that are really kind of focused on the broad concept of alternative assets. So Kimberly, really appreciate you taking some time out of your day to come and talk with us. Excuse me, if you wouldn't mind, give us a little bit of background about yourself and kind of how you kind of came to be at XA Investments now.
Yeah, absolutely. Alex, thanks for having me on. I think today is really the moment to be talking about, giving broader access to private market strategies. And there's a lot of interesting innovations, comes with a lot of opportunity, but some risk we should talk about as well. Our firm was set up 9 years ago to focus on making alternative investments more readily accessible using similar structures to a mutual fund or an exchange traded fund that every investor is familiar with and comfortable with, in their retirement accounts or in their savings accounts. And my career, the last 25 years, has been spent focused on product innovation. I help asset managers raise capital, and our focus is. I spent 12 years at Nuveen Investments, and Nuveen, I think, is a well-known, well-regarded firm, especially for their municipal bond capabilities. But that heritage in municipal bonds was what helped Nuveen establish a listed closed-end fund. These are exchange-traded listed closed-end funds. They behave differently than ETFs, but it was for me an interesting avenue to get into the private market space. These types of product structures are open, or allow the SEC allows asset managers to package less liquid or illiquid investments in a way that's not possible in a mutual fund or an exchange traded fund. So for me, my career has really been spent the entire time on these sort of innovative product structures. They're fairly niche. Your listeners may never have heard of a listed closed-end fund. And the work that we do now at my firm is focused largely on a different type of SEC registered closed-end fund called the interval fund. And this is really the product structure that makes alternatives more accessible. It is the only SEC registered product that delivers a 1099 that can house a wide variety of private assets. And so I think I think everyone's going to start hearing more about interval funds. So it's good that we chat about it a little bit, but that's what our firm was set up to do. We run about $1 billion. We're headquartered here in Chicago, and we actually have a research business focused on helping both advisors and investors and asset managers learn about the growing interval fund marketplace.
Great. So I think that's kind of a good place to start, at least. I always like to explore new things that are kind of burgeoning in the market. And I think it's kind of good to start to focus on, what you look at to put into these kind of things, because alternatives are, as broad as the day is long, right? It's, a large focus of what my career has been based on has been kind of the real estate market, and all the different niche things you can dive into with that. But, having a lot of experience within, other market segments, whether it's things like fintech startups, biomedical and different things that always need to raise capital. But the profile of those different types of investments when it comes to, packaging something together like a fund is markedly different, right? Sticking a private credit, holding for a real estate company next to a biotech startup within
Mhm.
some type of, asset class like this, I'm certainly assuming is kind of part of the challenge, right? So when you started kind of coming to, operate in these interval funds, what were some of the market segments that you really kind of look at? Because I'm assuming it's kind of a balancing act between cash flows, liquidity, because if you're going to be operating a fund, there's going to be entries and exits for investors as well.
Yeah, you're right. I mean, let's look at that spectrum of alternatives because, on the left-hand side, you do have some more liquid strategies, things like hedge funds, for example. In the middle, you have private credit, as you were talking about. There's a lot of demand right now for higher yielding, both corporate lending, type direct lending or asset-backed lending, but also real estate debt. And then on the far right, in terms of that liquidity spectrum, things that are less liquid. Think about infrastructure or private equity, where your investment horizon might be 10 to 15 years. And so there is this large spectrum. It's really anything, that's not a publicly traded security, something that's not a stock or bond is considered alternative. And so there's a wide spectrum of what that is. These strategies have largely been offered to institutional investors in a private fund. So retail investors didn't really have access. Maybe they didn't meet the investment minimums. Maybe they didn't have, $1 million to put into a single investment, or they didn't want, a K-1 tax form. So the whole notion of democratization is making these types of private market strategies across that spectrum of assets available for lower investment minimums without suitability restrictions or with lower suitability restrictions, but also the convenience of a 1099 and the protections of the 40 Act, which has an independent fund board, which requires transparency into the holdings. So there's a lot of advantages of these interval funds because of the SEC registration process that you have to go through. But in the research work that we do, Alex, to address your question about the spectrum, the in terms of the largest category of interval funds, it's actually private credit because everybody's been looking for alternative sources of yield. Number two actually used to be real estate because real estate, I actually view real estate as sort of a gateway, an entree. People invest in real estate, maybe they have a rental property, and it really helps investors understand the opportunities that exist outside of stocks and bonds. So I love talking with advisors and investors about real estate because they have a really good grounding to help them understand if they're going to evaluate something like farmland or something like infrastructure. There's growth across the spectrum. I mentioned that real estate used to be the second largest category. It's now the third. It was replaced in size by private equity. So private credit, private equity, real estate, and then hedge funds. There's also a lot of multi-asset products that have come to market, combining different private credit maybe with private equity. And so, there's close to 300 funds now in the marketplace. Obviously, not as many on offer as exchange traded funds or mutual funds, but there's a growing set there's actually about 150 unique fund sponsors. And so there's a lot of choice, I think.
Yeah, so the the first thing that I kind of like to dive into again with the three main points that kind of get packaged into these, private credit. It's, if there was a hotter topic in private equity right now, I sure don't know about it. But at least in the past year, the first year of the podcast, I think I talked to one person, back in 2022 about private credit, right? It was like, hey, we're doing this. It's kind of interesting. I'm like, yeah, it definitely is. Like the the aspects of, you know, liqu- the need for liquidity outside of the traditional routes offers, a fresh market for people to operate in, and especially what we've seen with, the more alternative focused lenders. I mean, look at Silicon Valley Bank. I think that whole fracture of that segment of the banking sector really threw a bunch of gasoline on this whole aspect of, hey, you don't have to necessarily be a bank. These people have a bunch of capital. Let's step in because we can, one, without the, overhead that comes with running a bank, be more nimble and be able to make these investments in a more judicious manner, that can yield the returns that we're looking for. So, from your perspective, when you're looking at private credit, when it goes into these things, what market segments of the private credit world are you focusing on? Is it more of the asset-backed lending for, capital needs of developing businesses or, startups? Is it more in the real estate realm, hybridization of all those kind of things? Where really is the private credit market that you like to focus on when coming into an interval fund really based in?
Well, so in our work, we break the private credit space into four main segments, the largest of which by assets is direct lending. And the market leader in the interval fund space is Cliffwater. Cliffwater is a institutional consulting firm that has the ability to allocate to multiple direct lenders. So creating a lot of diversification. And that fund, the corporate lending fund, which is their flagship, the yields are very attractive for investors. They're in the low teens. And so it's also brought competition to the space. If you look at just in the last year, Alex, you're right about the timing. This space is hot. Direct lending has brought BlackRock, one of the largest asset manager in the world, acquired a direct lender. This direct lender, HPS, is one of the largest direct lenders with north of 100 billion in assets. So what does BlackRock intend to do with HPS? Presumably package up that capability in direct lending. They have yet to launch in the interval fund space with the direct lending type product, but I'm sure that that's to come. After direct lending, in the last 6 months, the asset-backed lending, which is viewed as an alternative to direct lending, which is largely based on corporate credit, but asset-backed lending, in an inflationary environment, and if you're concerned about corporate credit, I think with the tariff volatility, a lot of folks have diversified into asset-backed lending, and so there's a variety of assets, machinery, aircraft leasing, you name it, hard assets that underlie the asset-backed lending. And each manager's approach is a bit different, but we've seen a ton of fund formation around asset-backed lending. The other category is structured credit. Think about RMBS, CMBS, or CLO debt, CLO equity, historically very high yielding parts of the market. And then the fourth category is multi asset within the different parts of the credit market. So we're more opportunistic. We're seeing some traditional mutual fund managers create multi-strat products which mix public and private credit, because there can be good moments in time to allocate more of the fund's portfolio to the private markets, and then probably opportunities when the public markets get dislocated. So we're seeing some dynamic strategies, and it's not just the alternative managers that are moving into this space, it's also traditional mutual fund shops. So the lines are getting blurred. The headlines this year was around Capital Group, which is also a very large mutual fund sponsor. They partnered with KKR to bring two private credit funds to the interval fund marketplace, and those products have just launched. They've launched with a management fee south of 1%, which is viewed as attractive. But once again, they're combining public credit with private credit. So I think as the number of choices multiplies, I think advisors and investors have to be discerning. It's like, do I need more public credit exposure on top of what I already have in my high yield portfolio or my senior loan portfolio? And so I think there's a lot of conversation around model optimization, model delivery, because now there's so many more options than there were just 2 years ago.
Yeah, I think you bring up a couple of really good points there. One being, you kind of alluded to it, is that the people that find private credit attractive come a lot from the bond market, right? They're very familiar with debt instruments, right? So it's not a necessarily relearning, the whole wheel to say, okay, look, I understand, whether it's municipal, whether it's federal, whether it's, private bond market. I understand the kind of the debt structure. So going into the lending aspect as opposed to the acquisition play on that probably isn't, the most difficult for them to utilize their expertise on, which kind of brings up the issue of, with how dynamic this market is being. Again, you just listed off four things within the private credit space, all of which are seeing different directions that they're starting to go as the kind of the market matures. Because at least from my perspective, and I know that the market is certainly much older than that, but really from the qualified plan aspect and arena that I operate in, private credit and private credit funds have really gained a lot of popularity in, let's say, the last 400 days, right? It's not something that is incredibly, has a long runway to look back at, okay, how are these things going? And then also with, like you were talking about, especially with, tariff pressure, maybe offering a more attractive play in the asset-backed lending space and the uncertainty that comes with that. I think we can all see just how uncertain it is with, I mean, in the past 2 weeks, we've seen tariffs go up to what, 50% for India. We've seen other things happen, and it's such a dynamic space that it kind of forces this market to be as dynamic as well, with different things moving up and down. So, do you see kind of I guess the real question I'm getting at is how do you kind of operate in something if you're trying to do something like an interval fund, which is aiming for, a certain rate of return in general for clients that has issues with, that should say have issues, that has, different metrics for what the liquidity and the entries and exits are with lower potential investment minimums for clients. How does that kind of play into what you're trying to do with that? Is it a tough thing to kind of navigate at the moment, or do you kind of have a general core focus of what your firm likes to aim for when it comes to the private credit aspect of the underlying asset base for the fund?
Well, you do have to have an investment horizon that's longer than a year or two, for it to be a worthwhile endeavor,
Hmm.
right? You were mentioning these interval funds do have limited liquidity. So if you're saving for a goal that's 5 or 10 years out, something like retirement, for example, you have a longer investment horizon. You don't need the money, next year. And so the trade-off is these structures allow limited liquidity. Typically, they're quarterly liquidity, but they only allow 5% of shares to be repurchased at NAV. The good news is you're getting NAV, it's not some sort of other price,
Hmm.
and the fund is redeeming those shares directly. But I think that time horizon, if it's April 2020 and you want your money out, more likely than not, everybody else is going to be looking for liquidity in that same moment. So, like in a normal functioning market, you'd be able to tap into the liquidity that you need. But if it's a crisis moment, there will be pressure on these types of products because they some people refer to them as semi-liquid. I would say that they're illiquid with periodic windows for liquidity.
Hmm.
And it just means that your time horizon has to match up with that. And if that is just outside of your comfort zone, absolutely not a good fit. But to your point, many of these funds don't have long track records. We track this statistic in the market. There's only about 50% of this market that has longer than a 3-year track record.
Hmm.
So it's hard to make a long-term investment decision based on such a short track record. Um, and I think that in diligence, you can, and that's why like a firm like yours or any sophisticated wealth manager, they're going to do due diligence. They're going to kick the tires on the asset manager and say, give me your institutional track record. I want to understand what you've been able to do through multiple market cycles. How has asset-backed lending performed? How did it perform in '08? How did it perform in 2018? Like you look for moments of volatility so that you can test it and figure out, is this something that makes sense in my retirement portfolio? And most asset managers, especially the alternative managers that are launching funds, have been managing these types of strategies for 20 or 30 years. They've been doing it for institutional investors. So I think it's the right question, and it's something that has to be asked because if you look at the literature, if you look at the fact card, you'll see that most interval funds have less than a 3-year track record. So
Hmm.
that's why I think to your point, you have to dig a layer deeper, and it helps to have a financial advisor or a tax planner, someone that's helping you access the information that you can't otherwise, right?
Yeah.
Because otherwise, you don't have enough information.
Yeah, and that's two things that I kind of, run into a lot with people that are new to the alternative space, right? It is a fantastic space to operate in. But the two things, one, are understanding the nature of liquidity in this space, right? For lack of a better term, everything on the New York Stock Exchange is basically liquid, right? The longest people that have to wait to get money out is a 24-hour clear on a mutual fund trade, right? There's just the notion that you come into a space that can offer, exposure to a lot of different market segments and offer you true asset diversification, right? Everything on a public market can be drawn down by, and we've seen it, can be drawn down by a tweet, right? It's not something that is true asset diversification. When you get into the alternative space, while the underlying indicia or the investment might be, a private stock or a limited partnership holding, you do get the ability to segregate risk. But you do take on a different risk profile. One, if liquidity is of a big concern of yours, understanding the liquidity models of these different funds, to your point about redemptions and different things being maybe redeemed at a slower rate, or at least being able to mitigate some of that with an NAV redemption, right? So that's, when it comes to democratization of alternative assets, it's important to understand where you have to, one, do your due diligence and understand the market in general, and two, for the fact that the onus is on you as the client and by extension your team to make sure you understand what's going on, right? You don't have, big the ability to just go and look at a Morningstar report of a particular fund investment. You have to maybe send an email or ask a question. It's like, hey, can we get on a quick phone call and talk to a fund manager or talk to your advisor that can engage with these people and look back through stuff and know which questions to ask. And that's kind of the other side of the coin, especially with alternatives, that yes, bringing this to the masses is great, but making sure, and part of what I do on this show is to try to bring the other side. Like, hey, here's what you need to do to understand how to navigate the space in general. So when it comes to, again, things like interval funds, which I think from a large perspective, I really like that the market has started to mature to the point where we start having funds that can, conglomerate a lot of the different alternatives out there, because it's almost a full-time job to sit there and individually pick an alternative asset to build a whole portfolio. And that's one of the great things about mutual funds in the public markets, is that you can say, okay, I want this mutual fund that focuses on X. It has a great fund manager. They have a good track record. I like their fee ratios. Let's do that. And to have that kind of model start to emerge with different types of products in the private space is awesome as well. So from the development standpoint, you know, what do you kind of think is the general avatar of people who really can benefit from the interval fund as opposed to a closed-end fund, that are coming into this market maybe for the first time, or are looking for, again, more of that managed aspect as opposed to, just picking individual stuff in the private space?
Well, I mean, Alex, you kind of identified the right target or the right person, which is that their expectations, there's, I think, a lot of worries that these products, because they are illiquid or less liquid, they're being missold. So many U.S. investors are over allocated to large cap technology stocks,
Mhm.
which carry a lot of volatility. So I don't think Americans are afraid of volatility. I don't think they're afraid of risk. It's return seeking behavior. So I don't typically think we have to warn people, but I think the benefit of diversification gets lost on folks when the stock market has performed as well as it has. Now, 2022 taught us, once again, reminded us that it is helpful to have other assets, if it's real estate or if it's farmland, something that performs when the stock and bond market don't behave. So expectations are really, really important. It's funny because we're all social media, and the none of us are patient anymore. And a quick story, my college age nephew wanted to sell his Nvidia, and so he asked my parents, his grandparents, for the money same day. And I said to my mother, I said, did you tell him it doesn't work that way? And it was a Saturday. So he wanted to sell the stock on a Saturday and get the money on a Saturday. And I was like, so people are growing up with the wrong expectations. And I was like, you got to sell it, you got to wait till it settles, and then you got to get the cash from Fidelity or wherever you take it. And I was like, it's just funny though but you have to bear that in mind that things are moving so fast that a quarterly liquidity vehicle is like what? Like you tell them that on the front end when they buy the product, but then when they want to exit and you remind them they have to wait for the next quarter, and then there's a period of time to get the liquidity. I don't think people really have a lot of patience for that. So I think it really does have to be a conversation. Is make sure that there's an expectation alignment. The other thing, Alex, too, that you mentioned about, I think there's a lot of innovation in the space. Morningstar has actually announced that they are going to start covering and assigning their medalist ratings. Now, they're not doing the star ratings for interval funds. And so a lot of advisors, I think, prefer the star ratings, but Morningstar has announced medalist ratings. Now, Morningstar is only covering a subset of the funds in the marketplace, a lot of which are private credit. But they're starting, and I think there's once again there's a fee sensitivity that we see in the evaluation of mutual funds and ETFs. And I think what's the appropriate client? The expectations, I think, should be that you're not going to pay the same price for the private market capability as you would for an ETF. And that's appropriate because if you think about capacity constraints, investing in the equity market is effectively without constraint, right? But investing in certain types of real estate or investing in certain areas of the market, especially the nichier part of the market, maybe venture capital is a good example, you can't deploy billions of dollars without the deterioration of returns. And so when there are capacity constraints, necessarily the finest investment managers are going to charge performance fees or they're going to charge higher management fees. So I think the lens in which we evaluate these types of private markets needs to start with the evaluation of the manager and the manager's skill, which is about the track record that we already talked about, and then it also needs to start with the evaluation of the structure. Is it a good fit for that manager and his strategy, and is it a good fit for you, the investor? Is it going to work in your portfolio? And so I think that's what I see. The industry is not there yet. Morningstar has been posting research, Substack posts, LinkedIn posts. They are very negative on the interval fund marketplace. They're coming at it from a fee perspective, which is how they approach mutual funds and ETFs. So I think there's a lot of learnings left, and some of this is going to shake out over time because we're going to have the opportunity to look at 5-year, 10-year track records, but some of these funds need to mature into that. And then some of these research outfits can assign sort of ratings on that basis. But assigning forward-looking ratings on the basis of fees, once again, because of those capacity constraints, I think is an issue.
Yeah, I think it's the way I kind of equate it in my mind though is that the public markets are basically operating on a model of it's your Wendy's, your Burger King, and your and McDonald's, right? You drive up, you can get it, it's cheap, it's fast. And the private market's more to the fact of like a Five Guys, right? It's going to cost you more, it's going to be a better product. You have to get out of your car, do the research, and actually go in and get something. You don't necessarily want, or it would probably be a detriment to take Five Guys and create it into a drive-through like a McDonald's. The quality is going to go down. You might pay less, but there is a value to what happens in the private market. The assets that they are operating in require more skill, more expertise to drive those returns. And when you can have that hands-on approach, right? We all can look at, against the analogy of food, you start with the fast food and then you get into fine dining. You're going to pay more, but you get a better product in the end because you have expertise, you have the people working to make it a better product. And we should all be fee sensitive, right? If someone's charging a an astronomical amount of fees to manage something to the detriment of the returns being paid to the investors, yeah, it's a bad deal. But if the fees are in alignment with the returns that can be offered and the track record and the expertise that they have, it's not necessarily a bad thing, right? But It's the model I think was kind of crafted back in, when I think it was at Scott Trade was the first one to come out with fee-free trading, right? People just get so used to the fact that, hey, this is free. And I run into it in my business a lot. People are like, well, why do we pay for your service? It's free at Fidelity. I'm like, it's not free. They're a $1 billion company. There's not a red cross above their door. They're making money. You just don't see it. And that kind of model, especially for the retail investor, the more sophisticated ones, your institutional level people, people in the position that you're in, understand where these things kind of operate. But that again, I think is kind of the barrier to entry to the private markets is when you're looking at a prospectus or you're looking at something and you're seeing a fee structure that is well without that is well outside what you're used to be paying, understanding where the value comes, right? And I think that's part of what the general population that would maybe benefit from exposure to the private markets, needs to understand. The second point that I really like that you kind of, allude to in there is I think that illiquidity is actually a benefit to the private market. To your point about I think it was your nephew that was like, hey, I want to sell on a Saturday and get my money today. It reduces the impulsivity of the investor, right? If you can't just, click sell and liquidate your entire portfolio at a whim, it allows you to be able to weather different types of market situations. It allows for the expertise of the people that are guiding the ship that you're investing your capital in to navigate and still create returns and value for you. Again, I do like the inherent illiquidity to a point, right? If every single thing in the private market is going to be a 15-year time horizon, well, yeah, that precludes a lot of people. But being able to craft different products that allow for some liquidity, because everyone needs cash, right? No one is going to be devoid of needing capital in their investment portfolio, but allowing for the long term compounding return effect to take place, I think is something that it can benefit probably more people than not.
Yeah, I think we agree, which is that you know, there has to be the benefit or the upside, to the illiquidity trade-off, meaning if you're not able to achieve higher returns with reduced risk or just simply higher returns, then investors' preference for the public equity markets will remain. I think what we've learned from endowments and pension funds is they've long used private equity and real estate, especially. Many of them have also used hedge fund strategies to try to diversify, enhance returns, you know, uh, and their return targets are 200 to 300 basis points north of just investing in a stock and bond, a 60/40 portfolio. Now you do have to have a long time horizon. These pension funds and endowments also have access to the best managers. So I think that the challenge is going to be as this market grows, because there are terrific asset managers, but there's also some just okay managers and some
Mhm.
bad managers, just as we find in the mutual fund space. But performance drivers are going to be different in this market than in the let's just take public equity. And so I think it's going to take folks a while to assess that and determine predictors of future success, which is what everybody's focused on, really, right? Because past performance is only one dimension to consider. It's really trying to anticipate. I think it also, Alex, speaks to why private credit is so popular, because private credit, you can communicate the current yield of the fund's portfolio. Now, yields can go up and down. You can also take losses, which hurts your net return, but at least you're able to communicate, this fund is yielding 11% on the basis of its current cash flows. Now, that is helpful because, and that's why I think we're seeing so much demand for private credit, because many of those funds are brand new. There's no fund track record, but the
Mhm.
total return is typically commensurate with that current yield. Things like private equity or infrastructure, you need multiple years for any sort of expected total return profile to become clear. And so that's what I think, those are not quite as much in demand. because people don't know what to anchor on, right? They're you're just being told an expected return target. It's a little squishy, I think. So that's what the challenge is with more total return oriented strategies.
Yeah, and to the point about, the actual, returns being paid out, the other really interesting aspect of the private markets is the ability for you to be very crafty with your tax strategy, which is kind of the world that I live in, is that depending on what type of investment that you are, plugging your capital into, it can offer the ability as opposed to the public markets where it's a pretty straight line. I mean, you have different, you have more ambiguity with what the bond market looks like from the end user for receiving in capital from that. But the traditional securities market, right? It's a tax lot basis. It's a what you just buy for, what you sell it for. That's your net gain or net loss. Whereas with the private markets, it's a lot more interesting from the aspect of saying, okay, well, if I'm going to be investing in a tax conscious fashion, right? Maybe I want to have some stuff plugged in that pays out on a K1, which will allow me to capture any type of depreciation and write-offs if it's real estate, things like cost segregation analysis that can really help to drive down any appreciable payment that I might be receiving, or to the point of saying, hey, look, I really like this because it does pay out on a 1099, and I have other things that can help offset that maybe from my traditional portfolio and how I'm actually balancing things out, which is it's the marketplace that I operate in with the tax shelters. So I always get a little nerdy on the tax aspect of it, but it's something that is very attractive. I don't think people appreciate enough when it comes to looking at the lens of the private market, because they're just saying, okay, I'm going to look at risk, I'm going to look at liquidity, I'm going to look at fees, but it's not how much you make, it's how much you keep. And the big elephant in the room has to always be taxes when you're looking at this stuff. And the private markets offer a very interesting play depending on how you do it, right? Not everything's created equal. Getting a tax advisor that understands what you're doing and what your goals are is very important for anyone, especially that likes to invest. But that aspect again, I think really plays out. Now, from the space that you operate in, are interval funds kind of all typically packaged in a certain way where they normally pay out, let's say a 1099 to an investor? What's kind of the general thought consensus in that marketplace for how these things are actually acquired and paid out to clients?
Yeah, all the interval funds and tender offer funds do pay out 1099s, but there's a real opportunity. There haven't been many products built with tax advantaged or tax qualified. There's a couple of higher yielding or esoteric muni strategies,
Hmm.
but I actually think that, like talking about private credit with the high yields, all of that's ordinary income. So if
Hmm.
it's not in a qualified account, then you're not keeping as much of it as you think, right? So I think there's a lot more to come, at least with tax sensitivity built into the fund itself, but also for wealth managers who are using these product structures. Um, uh, Blending, and that's why I think it's early in terms of how model delivery but tax is one key dimension, because you might have a private credit asset with a private equity asset and they would be complementary from a tax perspective. But I think it's smart for you to be talking about it now, because there's not a lot that's being done yet and there's not a lot that's being written. But you're right, wealthy investors are always going to be tax sensitive, and at this point, and not to say it's an afterthought, but it's just not getting the airtime that it needs to.
Yeah, and that's that's something that I think is a nice segue into the next part I want to talk about. Again, you're mentioning, doing some of these things that maybe pay out a 1099 that's going to be classified as ordinary income for people.
Right.
With recently, was it when the 18th or so, Trump's executive order on democratizing alternative assets for retirement plans, right? The directive generally being that he's directing the IRS and the Department of Labor to, reduce some of the barriers to entry to alternative assets for qualified retirement plans, namely your 401ks. And it's kind of really where it was focused on the ERISA qualifying plans. Now, it's something I think that can eventually be a net positive, but there's a lot of things from my perspective when it comes to how these plans are managed, and you really saw a really back prior to 2018, there was some play in the space with plans, but you had a directive from the Department of Labor redefining fiduciary responsibilities for plan trustees on the valuation basis. So we saw basically just a run to the hills from the trustee administration of these plans for anything that wasn't publicly traded or readily identifiable values. Now with this, again, we don't necessarily know how it's going to play out. That's one big contingent, is how that fiduciary definition is going to have to be has to be changed. For the plans to really get into that space. But also, again, to the risk profile and liquidity aspects, it's interesting, right? Because a lot of these plans are basically managed in an omnibus fashion. For those people that maybe aren't familiar, you set up your 401k and you tell them, hey, I want low, medium, or high risk profile for my investment. And they basically dump all of your deferrals, your non-elective, your elective deferrals into a bucket, and the fund managers go out and invest this pension as a whole with different allocations. The report that everyone gets and never reads will define how they are the fund performs and everything like that. But from that perspective, if they are going to be investing in that form of fashion, the broader exposure to one kind of things that we're talking about with illiquidity and different risk profiles, especially, and also mention cryptocurrency in there as well. That'll be a whole other thing to look at, with how that plays out. But, from your perspective, I'd love to get your thoughts on, how you think this is going to play out, from one, maybe the benefit perspective, or some things that you think, hey, we really need to get some definitions and clarity from the IRS and the Department of Labor to see how this stuff is actually going to play out in real time.
Yeah, I mean, it was the executive order had sort of a two-prong sort of one, a focus on private equity, and two, a focus on crypto. And the SEC chairman, the new SEC chair Atkins, is an advocate for both interval funds, having sat on the Cliffwater Fund Board for many years, and then also he is an advocate for cryptocurrency. Right now, in SEC registered funds, there are some crypto ETFs, for example,
Mm-hmm.
but if they invest in the derivatives of cryptocurrencies. So if you wanted to hold Bitcoin or other cryptocurrencies directly in a registered fund, a mutual fund, ETF, or an interval fund, at present, the SEC does not allow that. So I think there's a lot of innovation for private markets, beyond just private equity. The executive order was focused on private equity. Firms like Blackstone have been lobbying for years,
Mm-hmm.
right? And under the Biden administration and a lot of the clampdown, the fiduciary rule that you mentioned, none of that was happening. Blackstone didn't see any movement.
Yeah.
So, the executive order is sort of a directive to go figure it out, right? And now the industry, in collaboration with the SEC, needs to do that. Now, the Industry Association for Registered Funds in the US is called the Investment Company Institute, the ICI, and they're an advocate for figuring out how do we get interval funds into 401ks, because once again, the SEC rules do not allow mutual funds and ETFs to hold private markets. They're not liquid. And they're not going to change the mutual fund rules. Think about the 401k platform and all the technology. The chassis, if you will, was built for mutual funds.
Mm-hmm.
And this has been 40, close to 50 years of industry investment in technology and processes focused around the mutual fund. And so that's not going to be a fast change overnight. We also, while I think this is a positive signal that the SEC is going to focus on this and hopefully usher in some change with respect to private equity and cryptocurrency. The SEC staff is actually shrunk significantly in size. It's down about 30 to 40%, like a lot of the other federal agencies. So I think there's a willingness, but we're still going to have, to the extent that there's innovations or there's SEC relief that's required, we have fewer people to approve those necessary changes. So my guess is that it's going to take a while for not just the technology and the innovation. And so I think we're going to start slowly. I think we'll see it first probably in target date funds,
Mm-hmm.
CITs, which are not SEC registered funds, those collective investment trusts are used for a lot of retirement accounts, have already started incorporating exposure to private equity, private funds. And so I think implementation is going to vary depending on is it a blended target date with multiple underlying assets, or is it going to are we going to get to the point where any retiree or someone saving for retirement can just go pick from a menu of different interval funds? I think that's a ways off. I think we'll probably start by adding it to some of these blended portfolios because people view that as a less risky way to make that introduction. So I think we're ways off for individual investors having a menu of choice. I think we'll get there, but not yet. Just because of the way the 401k processes and technology are currently built.
Yeah, I think you're really, spot on with that. And to expand on that, I mean, 401ks, if you want to talk about a subset of the market that has a lot of a lot of chefs in the kitchen, if you will. I mean, you have the SEC directives, you also have the IRS for plan administration, then you also have the Department of Labor, getting their piece of it with how these things actually play out. So to say this is going to be an immediate type of change is
Yeah.
absolutely, I think, there's no certainties in the world, but I think that's about as certain as you can get. It's going to take a while for this stuff to actually matriculate out to the markets. The other interesting aspect that, I kind of look at is, let's say we actually do get this fleshed out. And I think exactly to your point, I think it's going to be one of those things where the private assets are going to be kind of a risk profile option for the ultimate participant in these plans. Do I want low returns that's blended bond market, public securities? Do I want medium, high, or do I want, a profile that is specific to alternatives? I don't think it's something that's going to probably be spread amongst the different risk profile categories in the typical administration of these plans like we've seen for the past, well, actually, 401ks turned 50 this year. Happy birthday. To that point, I think it's going to be its own separate bucket. And, where that capital is going to go, I think, again, the bigger pensions are going to start at the top. Your big private equity firms, your big interval funds, your big closed end funds. But it leaves a lot of interesting aspects on the middle market, right? Your your firms that are capitalized, let's say somewhere between 75 to $10 million, right? Those people are going to get a lot of interesting exposure because it's going to draw eyes to the market, but it's also going to allow maybe the smaller plans, like we have here, where I work at Advanta IRA, with maybe, well, granted, we already do have the ability to do alternatives. So maybe I'm a bad example, but your smaller firms that maybe have a small local TPA that want to get involved in stuff that don't have the desire to go to the big stuff that maybe do kind of operate in that space to bring a lot more capital to that part of the stack for the private market. That's where I see it being pretty interesting to see the amount of capital that can flow into these markets because right now the retirement plan market in the United States between your large collective bargain pensions, your 401ks, IRAs, somewhere around like $37 trillion worth of it's a little bit more than our national debt of just capital that's in these plans. So to kind of open up the doors to those being able to go into the market is going to be interesting to see how it plays out. But again, to actually how it actually goes forward, especially with the private stuff, I don't know. The interesting thing is going to probably be the cryptocurrency play of that actually does actually come to fruition because even if the plan trustees are allowed to do it with all the changes that need to happen, having known plan trustees for the past 15 years in the space that I operate in, they are very risk averse to things that can ultimately functionally harm a plan. And with how volatile some cryptos are, I think that most of them, until they die or retire and you get new blood in there, are probably going to steer away from it.
Yeah, Alex, I think there were a few of these private equity firms that have been huge proponents of putting private equity into retirement accounts. They were shaking their head about the crypto because they didn't want it bundled, they didn't want it
Yeah.
tied together because I think they're, I mean, I'm sort of a skeptic on crypto as an investment. I think like anything, people should do that if they want. They should have access, but you can also. It's pretty easy to go set up a crypto wallet, and I don't know because right now. The nature of that investment is very different from a lot of these actively managed private market strategies. They're going to
Hmm.
behave differently, and that's fine. But I think the question is people do have access to Bitcoin and other cryptocurrencies.
Yeah.
It's not, anyone can set up a wallet. So that's why I think the case for it, though, the need for it is very different. And but I think it's more that it's headline grabbing. There's obviously a lot of enthusiasm for trying to grow crypto and legitimize crypto and sort of applications of crypto. So, we'll see. I think you're right. Like a lot of the substance and the plans are going to be forthcoming, and it will definitely be a huge driver for the interval fund market. This marketplace is already growing at a compounded 30% annual growth rate.
Hmm.
And, 50 funds launched last year. We're expecting about 75 new funds, to launch this year, which may not sound like a lot, like compared to ETFs. I feel like there's an ETF launch every minute, but there's also an ETF closure every minute. And that's not happening with these interval funds, partly because it's just a very long, arduous process to get one launched, and that's why we actually have a practice helping managers do it the right way, because these funds are not easy to form. You have to have a long-term sort of commitment to do it and to build it out. And I think most of the managers that we work with are doing it the right way. Um, because like anything that's worthwhile, you have to be committed to it. And so we are optimistic because we see a lot of good behavior from asset managers who are committed. I mean, there's a lot of selfish motivations. Why do these managers want access to this $1 trillion market that you describe? It's because the retail marketplace is growing. It's because we're responsible for managing our own retirements. We don't have pension funds anymore. So obviously, with those institutional capital pools shrinking and the retail capital pools growing at a very fast pace, it's no surprise this is happening. It's just the market is kind of has shifted, right? I mean, people haven't had pension funds for many years, but it's just that, all of the consultants and the bankers and the investors have woken up to what's the next 20 years of growth going to look like in the investment space, and it is going to be focused on the private markets. I feel like the last chapter was the ETF chapter. This next chapter is about interval funds.
Yeah, no, I completely agree with you, and I think that's a great place to kind of come in for a landing. It's just the amount of eyes that are continuing, prior to this, executive order notwithstanding, has been increasing by, an almost exponential fold every single year. The segments that they kind of focus on shift a little bit with, private credit being the hot one right now, with interval funds being the product to package them in. But just the amount of eyes and the growth, I mean, just looking at our growth of our AUM for our clients over the past, 5 years has been, wild. I mean, we went from, I think in 2019, I think it was about 1.9 billion AUM to over three and a half right now, for just clients adopting a viewpoint to want to invest in alternatives. And this is just with retirement plans. We don't handle
Mhm.
personal money. So if you can extrapolate that to what people want to do in general and the sentiment towards the private markets, I think you are bang on with that statement of, now is a great time for people to at least look at it, right? Get educated, understand how this stuff works, because if that's where all the capital and the expertise is going to this, with the expert fund managers, with the people that know how to make these decisions and navigate these markets, it's a good time to understand how to deploy your capital in there at a as safe and effective as safe as possible with any investment, but more so to an effective manner for what your end goal is. So again, I really appreciate your time today. It's great to get to talk with people that are have such a basis of expertise in especially the alternative space, because there's not a ton of them that are out there, at least being vocal about it. So I really do appreciate your time to come on and talk with us today. If people are interested in learning more about kind of how your fund operates or other opportunities that you have, what's the best way that they can reach out to you?
Well, we post daily observations on the interval fund market. So you can follow me on LinkedIn or XA Investments on LinkedIn. Our website has a knowledge bank, so a lot of the research that I've referred to today is available there for advisors or investors. And you can even sign up on the website if you want our monthly market update. We make that free to all who want it. So yeah, I think your advice is sound, which is this is a really exciting area. So get smart on interval funds, and it's going to open up a lot of interesting opportunities. So thanks, Alex. Appreciate you having me on.
Absolutely, Kimberly. I really do appreciate it. As always, this has been the Alternative Investing Advantage podcast. My name is Alex Perny, and we will see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.